Hi everybody, welcome back to 10 Minutes with Griffin. I'm your host, Griffin Bridgers, and for today's episode, episode 124, we're going to invoke for the first time some visuals in our presentation, and we're going to look into understanding effective estate tax for capital assets. There's a lot of misunderstanding with the estate tax, and a lot of people tend to look at it myopically, but you need to look at it holistically across the whole tax picture. And that's what this presentation is about. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, capital assets, we're not going to dig into the definition much, but those are generally going to be considered non-depreciated investment assets. And if these assets are sold during your life, the sale is going to have the following income tax consequences. One, you're going to have a basis in that capital asset. Your basis is really usually your original purchase price. And that's going to be returned to you free of income tax because that represents income that you received previously that you were already taxed on, and then you invested that after-tax income in the capital asset. So you usually get your investment back free of income tax. But the growth on your investment is known as gain. And gain is the difference between the sales price for the asset and the basis. Now, depending on how long you've held the asset, you're going to have different income tax rates that potentially apply. If the asset has been held 1 or fewer years, your top tax rate is going to be 37%. It's going to be considered a short-term capital gain. However, if your asset has been held more than 1 year, you're going to have what's known as a long-term capital gain, and you're going to get lower income tax rates on that gain. So you're going to have a 20% gain in most cases. That's going to be the top rate. It could even be 0% or 15%. Now there's some other types of assets like depreciated real estate that might have a 25% rate, or collectibles that might have a 28% rate. But for the most part, 20% is going to be your federal income tax on that long-term capital gain. Now, the estate tax applies to the entire asset's value at the time of your death. So the entire basis and gain will be subject to a 40% tax. Now we're going to look at that ignoring the effect of the estate tax applicable credit, which can skew this and make the estate tax rates even more favorable when you look at it from an effective rate analysis, which is how we're going to close out today's presentation. But the big difference here between the income tax treatment and the estate tax treatment of the capital asset is that the basis of the asset is subject to estate tax, while only the gain is subject to income tax. So here's a quick comparison of the tax components. As you can see on the income tax side, the basis is not subject to income tax, but the appreciation or the gain is. Whereas for the estate tax, the entire asset is subject to estate tax or even to gift tax if transferred during life, including the basis. And these are your general tax rates that are going to apply, at least federal tax rates. You're going to have a 0% tax on the basis from an income tax perspective, and on the gain, you're typically going to have a 20% rate or 25% or 28% as long as it's a long-term capital gain. Now, from an estate tax perspective, you're still going to have a 40% rate that applies to the entire asset. So, one key point here to note is that after death, if a capital asset is sold, there is a basis step up which eliminates the income tax on that gain post-death. So, by virtue of applying the estate tax to the gain, that gain is eliminated. But the basis is still subject to estate tax, but we're only really concerned here with the 40% tax as applied to the pre-death basis. Now, because the gain is eliminated, looking at the federal tax only, This really means that the effective estate tax on the gain, if it's a long-term capital gain, is going to be between 12 and 20%. And if it's a short-term capital gain, it would be 3%, but there is one key difference here. All gain is treated as long-term capital gain for an asset with a stepped-up basis. If there wasn't that rule, or if you had ordinary income, there would really be an effective rate of 3%, and that might even be lower because of a deduction that the beneficiary gets for income in respect of a decedent potentially, if there is no step up in basis. But that aside, that's a discussion for another time. So what this means is that lower basis assets have a better effective estate tax rate, since the entire basis pre-step-up will be taxed at 40%. So this gives a holistic strategy that we're going to talk about in a minute. So both before and after the step-up, the basis will always have a 0% income tax, but the pre-death basis will always have a 40% estate tax. So here is an illustration of the effective tax rates at the end of the day. So income tax in the hands of the beneficiary is practically eliminated for any gain that accrued prior to the original owner's death, while the effective estate tax rate continues to be 40% on the pre-death basis, but will only be 12% or 15% or 20% on the gain that was eliminated by virtue of the step up in basis. So ultimately, the beneficiary is not going to have to pay income tax on that gain. So that's what creates the effective estate tax rate here. Now, it's important to note that the effective estate tax on the gain might be lower, for example, by elimination of state income tax. So if we're looking at a state income tax that could apply, that's going to reduce the effective estate tax rate on that eliminated gain even more. So overall, what's our key takeaway here? Our key takeaway is going to be that when it comes to estate planning, even if the estate tax exemption is changed, it's going to continue to be a better strategy to try to gift away high basis assets during life, and then hold on to lower basis assets in order to gain that step up in basis at death, because that step up in basis is going to lower your effective estate tax rate. Now, if the estate tax laws completely change to a regime that's more like the Canadian deemed disposition tax, that strategy might be flipped. But that is a discussion for another time. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.